on the line with us Michelle Schneider, Chief Strategist at Market Gauge. Mish, thanks for joining us. Now, let's start off with the announcement that came out of the Fed. The Fed kept rates on hold as expected between 5.25 to 5.5%. But what do you make of the language used by Jerome Powell that suggests 3 rate cuts this year are on track?
Well, we can't forget that we have an election year, so there is some motivation from that point of view, and also motivation on the rate cuts from the fact that the interest on the debt that we have is so high that they need to either keep rates where they are or lower them just to be able to afford to pay back the debt based on those interest rates. So none of this was a big surprise. What was a surprise was that he came up with what I believe to be a different way to say transitory. When we're talking about inflation, his exact words were that there could be seasonal effects in inflation data. And I found that to be surprising in essence, because we're seeing some real rises in inflation data, not just from the CPI and the PPI, but also if you're just looking at raw materials. So I guess the bottom line was this. It seemed to me and to many others, and obviously to the market, that he was putting aside any real inflation concerns for now, and instead more worried about what's going to happen potentially with the job market, and obviously looking at the data going forward. He seemed to feel in his projections, if you looked forth into 2025 and 2026, that we were going to be able to reach the 2% inflation target by 2026. So whether the market believed it or not is irrelevant. What we did see today was everything go up. And the dollar drop. Obviously gold rallying to new highs again, the SPY S&P 500 rallying to new highs again. And so one of those two things is going to turn out to be right.
Mish, I see that you are tracking 3 commodities as bellwethers of inflationary pressures, oil, gold, and silver. What are their current prices indicating? And I mean, first of all, gold is at very, very lofty levels right now, and oil is on a slow uptrend. How do you think that they might influence any direction going forward?
Well, it's interesting because seasonally right now, you do have a strong market for oil, and the demand has been much greater than what was anticipated. But of course, you always have OPEC in the background threatening to open the spigot, which could put some pressure on the oil market. But for now, the inventories have been relatively low. And there seems to be somewhat of a discount with everything that's gone on in the Red Sea and disruption with supply chains. So the fact that it's over $80 a barrel, though, is significant, and I'm talking about West Texas. And that means to me that right now, especially if you're looking at gas prices in the United States going up, that we have to keep our eyes on that, because if we start to creep up past 85 in WTI, now we're in territory where it can easily go from 85 to 100. And the fundamental reasons won't even matter at that point, because commodities tend to be extremely emotional when they start to go parabolic. So that's where the oil is right now. To me, if you go back to the 70s, the late 70s, oil did its thing in the mid 70s. And by the time we got into 1979, when inflation went out of control, oil wasn't really the factor that was involved. So the second thing, of course, that you mentioned would be gold. Now, gold has been going up all year. And once it took out the 2000 range, that was clearly why in the beginning of the year we saw it trying to get through 2100. It got through 2100, and now here we are at 2200. Gold is going up for 2 reasons. One, of course, is there's a flight to safety. There's been 3 reasons. There's been a tremendous amount of accumulation of assets of gold outside of the United States. And now gold could be reacting today to fear that inflation will start to creep up again if the Fed maintains this 3 rate cut policy and doesn't really seem to be looking the way of inflation. And then silver is important, in some ways more important in terms of, are we just going to see hotter inflation, or are we going to see inflation out of control? Because historically, silver will outperform gold when there is hyperinflation. And silver came up today, but it's still not doing anything that it needs to do to really raise eyebrows on inflation going out of control. But that doesn't mean it wouldn't necessarily happen.
Mish, from all you've just said, it sounds like the US economy is heading, or at least the world is heading towards a period of inflationary pressure, especially oil. We're heading into the summer driving season in the US. It's already, WTI is 81. And it seems like inflation might rise. And yet the Fed is pushing ahead with this 3 rate cut. At what point do markets kind of take note of this and do a correction, especially since so much of the reason the markets have gone up have been concentrated on the Magnificent Seven?
Well, that's a really good question. And I think the answer would be twofold. Number one is we have to look and watch the long bonds, which even though the market rallied like crazy today, the long bonds yields actually rose a little bit while the shorter yields actually dropped, which is an interesting type of steepening of the curve as opposed to the inverted curve that everybody's been looking at for more recession. So basically what we have to see with the TLT is how that behaves relative to, let's say, the S&P 500, because if the TLT reverses and starts to actually rally from here, or the yields drop in the long bonds, what that in essence does is gives it a risk-off environment where the equities would start to get nervous, but commodities can continue to run. We also have to look at the dollar, because the dollar, even though it went up a little bit against the yen after the Bank of Japan had finally ended negative interest rates, today the dollar dropped after the Fed announcement. And there has been a lot of global talk about the dollar dropping further as different countries start to figure out how to price commodities in something else other than the dollar. And so those are two things that would spook equities terribly and totally goose up the price of commodities further.
Mish, can we turn our attention to, I think, the tech sector? Not all FANG stocks are created equal. Apple's year-to-date return is minus 5%, while NVIDIA is up a massive 85%. So in terms of generating returns from tech stocks, how exactly do we separate one from the other?
Well, NVIDIA, the technology and the innovation coming out of NVIDIA has been extraordinary. And of course, fueling AI, NVIDIA is really in a class by itself in terms of designing chips. And there was a big announcement yesterday about how they're making the chips even faster and even smaller. And we know that demand will continue. And it's interesting because people say at what point is NVIDIA overvalued? And actually, if you look at PE ratios, it's not even as the high where it was, say, in 2021 after COVID rally. So calls for 1,200, 1,300 are not crazy. That will have, unless something dramatic happens where they can't produce the chips for whatever reason that might be, that I think will continue to stay lofty. The question is, what's your risk reward at these points? If it's 900, can you make another $200-300 out of it? And what would you be willing to risk if it started to correct? Apple's in a completely different world. The innovation in Apple, they put a lot of money into the headsets, and they are not selling the way they had hoped, number one. Number two is in terms of other innovation, it's not really been anything all that great as far as the iPhone goes, but they did announce this week that they're looking in a partnership with Alphabet and Gemini to AI power iPhones, and maybe that will give it a boost. But then they got another hit today because there was an announcement that the Department of Justice in the United States is going after them for antitrust. So Apple's just had a string of bad luck, while NVIDIA has been the golden child all around, and every single person wants to be an NVIDIA, at some point, and doesn't care what they're paying for it because they just think it'll never go down. And there's talk of split, but at that point, that hasn't happened either, a stock split. So that's kind of how you have to really look at things. This has been a year where if you follow the momentum, you follow the stocks that are outperforming, they are continuing to outperform. NVIDIA, of course, being the numero uno, but there are other stocks like that as well.
Mish, thanks so much for speaking with us. That was Mish Schneider, Chief Strategist and Managing Director at Market Gauge Group, giving us her take on some of the trends that she sees moving markets in the days and weeks ahead.